Hey, Jonathan Goldhill here, business coach and author of the book Disruptive Successor, focusing on next generation leaders in family businesses. And I've been taking you through a series of videos, and this last one is on my seventh P in my 7Ps framework. And that P is performance. How well is your business performing? And we measure performance in a number of different ways, right? We measure it in terms of profitability. That's the most obvious way that most of us. But also, what about the return on your investment or capital that you have in the business? That's an important source of performance that I talk about and walk you through in my book. And you also want to know, what is the business generating in the way of cash, and how well are those profits being converted into cash? So to quote Keith Cunningham, he said you need to be very effective at acquiring assets that maximize and service revenue, then be very efficient at converting those revenues into profits, and finally be very productive at converting profits into cash flow. The way we do this is by managing key performance indicators that we are measuring on a weekly and monthly basis that will drive us to the ultimate result that we're looking to see on our profit and loss statement and our balance sheet. And so we need to understand very clearly the three types of statements, which I'll discuss in my book: the balance sheet, the income statement, and the cash flow statement, as well as you need to monitor key ratios. And these go into your KPIs. And so things like profitability ratios, leverage ratios, which is really how much debt you have relative to your equity, liquidity ratios, which are things like your working capital and net working capital, and things like your activity ratios, which is turnover of receivables and payables. So by tying all these things together, you can drive towards the kind of performance that you ultimately want, because at the end of the day, you could put your money into a stock or bond that is publicly traded, or you could put it into your own business. Which one are you going to get a better return on? What kind of return do you anticipate getting? And it starts with putting together a budget, a pro forma that drives you to that result that you want to get. And hopefully at the end of the day, you'll be getting more return and better returns, and ultimately have more options when it comes to exiting the business than you would by putting it into a publicly traded company or a bond. So that's it. Signing out. Hope this has been helpful for you, and look forward to talking to you on the other side.